just some information for a division where we'll look at the ROI and the RI. So the return on investment is a pretty simple equation. It's just taking the profit divided by the assets. So in this case, we're going to take the $66,000 of income divided by the average investment. And we need to recognize that this will be different based on the industry. So different industries will have different benchmarks. And when you're using this as a method of management control, you'll want to make sure that the asset value is something that can be controlled by the managers. And you may or may not include something depending on what type of incentive you wanted to place on that manager. So if idle assets are important to divest, then you would include that in that total amount. And if you don't have any need to have those assets eliminated, then you might not include them in the $440,000. So there is some flexibility in what you measure. There are some disadvantages in your textbook on pages 854 to 856 that you should read. And one of the major disadvantages is just the short-term nature of this type of metric. The return on sales and the asset turnover are here. Return on sales is just simply the profit divided by the sales, and it measures the manager's ability to increase revenue and control expenses. So 8% on every dollar of sales results in profit. So 8 cents on a dollar. And the asset turnover is where you take your 825, you take your sales divided by your investments, and this measures the manager's ability to increase sales from a given level of investments. And what you can do is look at these two equations combined, and the 825s cancel each other out. So basically, if you take the 66,000 divided by the 440,000, you'll see that gets you back to your ROI. So if you take your return on sales multiplied by your asset turnover, the 825s cancel each other out, and so you end up with the return on investment. Residual income is next, and that's where you take your net income, which is the 66,000, and you subtract your expected level of return. So it measures your income earned after paying a charge for the funds that are being invested by management. And so we've got a positive amount in this case. And the one advantage of the RI over the ROI is that you can change your interest rate. So if the minimum rate of return was actually 13%, you can adjust your calculation, and that will change your ending value. So again, this is one advantage here, is that you can adjust your interest rate for different levels of risk, where you can't really do that in the ROI. You come up with one interest rate.